In today's video, I'm gonna help you understand when you should and when you shouldn't work with a financial advisor. Hey everybody, I'm James Knoll, founder of Root Financial, and I'm here to teach you how to get the most out of life with your money. Big disclaimer here, I am a financial advisor, so what I'm gonna be talking about isn't just theory, it's specifics of what I've seen both inside the industry of how different financial advisors work, as well as from a consumer's perspective. What things should you be looking for if it's gonna make sense for you to work with a financial advisor? So what does this decision come down to? Well, it comes down to cost. When you work with a financial advisor, you are going to pay a fee. So what you as a consumer want to know is you want to know, will I get value that exceeds whatever cost it's gonna cost me to work with that financial advisor? That's what I want to help to clarify you. Understanding both the knowledge inside the financial advisor world of how different financial advisors work, also understanding various consumers and people looking for financial advisor work. What is it that you need to be looking for, and how can you understand if the value that you're receiving is going to exceed the cost that you're paying? So let's start with that. Let's start with the cost, because my guess is when you're asking yourself, should I work with a financial advisor? The first thing that comes to mind is the cost there. Now, that's not a bad first question. You want to understand, what am I going to be paying to get this? However, if that's the only question you're asking, you're missing the bigger picture. What you also have to ask yourself is, what's it costing me not to work with a financial advisor? What's the cost of having the wrong asset allocation throughout my retirement? What's the cost of missing out on some serious tax planning that could save me tens or hundreds of thousands of dollars or more over the course of my retirement? What's the cost of making the wrong decision at the wrong time? What's the cost of not maximizing my income in retirement? And then my biggest one is, what's the cost on my peace of mind? What's it costing me in terms of sleepless nights or anxiety or just always thinking about money if I'm not working with someone who can help to ease some of the burdens or ease some of the concerns I have when it comes to doing my financial planning? So today we're gonna go over all of that and more so that you can make the decision that's right for you, because again, going back to the cost aspect, what we typically think is we think, okay, if I'm gonna work with a financial advisor, it's almost like I continue doing what I'm doing, but now with the cost layered on top, which is not the right way to think about it. If you're working with a good financial advisor, we need to understand the cost on one side, but we also need to understand the cost of not doing so, of not working with the advisor, so we can start to weigh that and start to understand what works best for us. So let's start to unpack some of the benefits of working with a good financial advisor. And number one, right off the bat, I'll say is having the right asset allocation. I've had so many people come to me and they have a 50-50 allocation in terms of 50% stocks or 50% bonds, or 90-10 or 60-40, and I'll ask them, where did this come from? And oftentimes their answer is just inertia. It's just what I've been doing. Or maybe I read something that said I should have a 60-40 portfolio. Or maybe a decade ago, a family friend recommended a 50-50 portfolio. Or maybe it's, I've just been all stocks my whole life, so I haven't really changed it. Well, it doesn't seem like a big deal, but when you start to understand how can different asset allocations add to your portfolio value over time, it's a huge difference. And the cost of being too aggressive, we all know what that feels like. The cost of being too aggressive is you might potentially run out of money if there's a major downturn and you don't have a plan to get through it. Now, the cost of being too conservative, there's also a huge cost for that. The cost of that is underperformance or opportunity cost that can quite literally be to the tunes of hundreds of thousands or millions of dollars over time if you have the wrong allocation. So as you're looking at this, people oftentimes say, well, you can't outperform the S&P 500, so why would I work with an advisor to give an asset allocation? Well, when people say you can't outperform the S&P 500, it's an entirely different conversation. It's saying, look, active management, costly management, if your goal is simply to outperform an index of large US stocks, you're gonna have a hard time doing so, because history shows us active management trying to outperform the S&P 500 just doesn't work. Now, that doesn't mean everything should be in the S&P 500 like some people wrongly believe it to mean. That has nothing to do with, well, what about owning some small companies, which historically outperform the S&P? What about owning value companies, which historically outperform the S&P? What about diversifying to international or emerging markets or real estate or bonds or all the different things that are necessary to make your portfolio come together? When people wrongly think, oh, I can't outperform the S&P, or an advisor can't outperform the S&P, therefore there's no value in it, well, understand that having the right asset allocation for you is far more important than outperforming the S&P. So getting that allocation right is crucial to your ability to maintaining a comfortable lifestyle throughout retirement. The second benefit is tax planning. Now, if you've gone to an advisor and asked them a tax question and they said, go ask your CPA, you probably don't have a very good advisor. It's impossible to separate the tax aspect of financial planning from the investment aspect of financial planning. And if you're retiring and most of your money is in a company 401k or a traditional IRA, it's no secret that you're going to be paying taxes on that money as it comes out. And whether you want to or not, there's going to be a time at which required distributions force you to start pulling money out of those accounts. So how do you have the right tax strategy? When it comes to Social Security and taxable accounts and Roth IRAs and 401ks and pensions, all of these things are treated differently from a tax perspective. So how can you get the right withdrawal strategy in place to ensure that it's not just growing your portfolio to the largest size that you're concerned about, but it's how can you increase the amount that you take out of your portfolio on an after-tax basis, not just year 1 or 2 or 3 retirement, but year 10, year 20, year 30, making sure that your overall retirement tax liability is as low as it can possibly be. A third benefit of working with a good financial advisor is getting the most income out of your portfolio. Too often people just blindly follow the 4% rule. The 4% rule is saying take your portfolio value at retirement, take 4% out for the rest of your life, and start there. Well, it's simple enough, but if that's all you're doing, you're likely leaving a lot of money on the table. Keep in mind the 4% rule is designed to say, what if you retire and we go to a horrible market and there's horrible inflation? That's the most you could take out of your portfolio, assuming it's invested correctly, without running the risk of running out of money within the first 30 years, using history as a standard that we're applying that to. Now, what if you don't retire into the worst market environment of the last 90 plus years? Well, if you're only taking 4% out, you're likely leaving a lot of income on the table. Take 1975, for example. Had you retired in 1975, if you read the 4% rule, if the white paper that this is based upon, well, in 1975, you could have taken about 7.5% out of your portfolio. So if all you're doing is taking 4%, let's assume you have $1 million portfolio, well, you're taking 40 grand per year when you could have been taking 75 grand per year. So think about that. What does that cost? What does that cost in terms of missed opportunities? Time with family or friends you could have had, but you didn't because you didn't think you could afford it. Experiences you could have created, trips you could have taken, that's a real cost that you can never get back. So if you don't have the right income and withdrawal strategy, you're likely leaving money on the table in terms of understanding the most that you can possibly take from your portfolio over time. And if you miss that, especially in the first 5 to 10 years of retirement when you have your health, your energy, the ability to travel freely and to live freely, you never get those years back. So what does that cost to not have the right withdrawal strategy? Another benefit of working with a good advisor is almost having those personal guardrails in place. You know, we talk about portfolio guardrails and withdrawal guardrails to understand how much can we possibly take, but personal guardrails are important too. Let's use the analogy of bowling. The first time I went bowling, it was a disaster. I was bowling that ball and it was going into gutter after gutter after gutter. And so instead of trying to get better, I said, you know what, there's an easier solution to this. I'm just gonna put the bumpers up. Now, what did that do? If I threw the ball too far to the left or if I bowled the ball too far to the right, it hit the bumper and it just kept me in line. And what happened is every single time I'd hit the pins, every single time I got to my final destination without going too far off the rails on either side. That's what a good advisor should do for you. Because when you retire, you need to make sure you have an advisor that's gonna not let you spend too much money. It's easy to say, okay, I'm just gonna spend now, I'm gonna travel now, I'm gonna do these things now. But if you're not careful about that, you can start to take an unsustainable amount from your portfolio, which costs you big time in the future if you've spent down your portfolio and no longer have income to create. Now on the flip side, if you're so conservative because you're so concerned about the future and spending down your portfolio that you spend too little, well, that's where the opportunity cost comes in. That's where life passes you by. You're so busy being worried about overspending that you underspend to the extent that you wake up 10, 15 years from now and you realize, I now have way more portfolio than I could possibly spend over my lifetime, but I can never get those years back. I can't make up for spending now. I can't make up for the times I missed with grandchildren or with friends or pursuing hobbies and activities that would really bring me a lot of fun and enjoyment. So a good advisor should serve as those personal guardrails. They should serve as that bumper to an extent of you go spend what you want to spend and I'm going to keep you in the lane here to ensure that we get to our final destination without ending up in either the gutters. And then finally, my favorite benefit of working with a good financial advisor, it makes you happier. There's a study by someone named Sonia Letter, where she interviewed and she examined 1,000 different people who worked with an advisor and who didn't work with an advisor. What she wanted to understand wasn't the tax strategies, it wasn't the asset allocation, it wasn't what are they doing in terms of their social security. It was how much happier or how happy are you both with an advisor and without an advisor. Now here's the interesting thing that Sonia found in this research. She found that $1.2 million in assets was kind of that point at which people started becoming much happier working with an advisor compared to those who didn't have an advisor. And this makes some sense because if all you're living on, for example, is Social Security or a pension, there's really just not much an advisor can do for you. Yes, they can provide some basic guidance and provide some general budgeting expertise, but in terms of managing your asset location, or your asset allocation, or your tax strategies, or all these different things that create a lot of complexity, there's just not much there. But she found that once retirement assets or once portfolio assets hit 1.2 million and above, the level of happiness started increasing for those working with an advisor, and it actually started to cap out around $6 million in assets. What does that mean? What that means is the people who are paying most, those with more portfolio assets, were actually those that were happiest with an advisor compared to those without an advisor. And nothing to do with they were happy because they had 6 million and the other person didn't. It's people with that portfolio level who worked with an advisor compared to people with that portfolio that didn't have an advisor. That's where the level of happiness was really maximized. So what does this tell us? It tells us that it's much more than a cost decision, and it tells us that as your level of complexity grows, we often have this sense of, okay, when I have $1 million, things are gonna be so much easier. Or you know what, when I have 3 million in my portfolio, things will be so much easier. Or 5 million or 10 million, those goalposts tend to keep moving. But what we start to realize is the more our portfolio balance grows, the more complex our lives get, what we start to realize is much more of a burden there. There's much more of a responsibility there. We understand that the cost of a mistake is much higher at that level. And even if you go through retirement and never pay an advisor a dime, but you're filled with anxiety and worry, and these thoughts are consumed with what are you doing wrong with your money, that's a horrible way to retire. There's a saying that I like to repeat a lot. And what it says is if you're still worried, you aren't wealthy. So it doesn't matter how much money you have. If you're constantly worried about it, you're not truly wealthy. It's having the right amount of money for you and having the peace of mind to know that that money can do for you what you ultimately want it to do for you. That's true wealth, is the freedom to pursue what you want to pursue without being weighed down with the burden of carrying that responsibility on your own. You'll often hear me say in these videos, we want to help people get the most out of life with their money. Well, why do I say that? Because at the end of the day, it's not about the money. It's about what can this money do for you? What can this money do for you in terms of your ability to be with family or have experiences with family? What can this money do for you in terms of your ability to live where you want or travel where you want or do what you want? What can this money do for you in terms of your ability to maintain the lifestyle and do the activities and engage in the types of things that bring you a lot of joy and contentment? What can this money do for you in terms of your ability to support charities and causes that you really care about? At the end of the day, if we're not using our money as a tool to get the most out of life, we're missing the whole point of money. So when we understand that, we need to understand that a good financial planner shouldn't just tell you what to do with investments and taxes. They should be doing all of that in terms of helping you maximize what you can get out of life with that money. So real quick, let's just go over some real basic things that tell you it's time to maybe work with an advisor, or if you have an existing advisor, make a change. Number one, the first thing that you should look at to know it's maybe time to work with an advisor is all of your money's in the S&P 500. What that means, if we're honest with ourselves, is we've been chasing performance to an extent. The S&P 500 has done incredibly well over the last decade plus. Now, if that's all we're looking at, we might have a hard go at it into retirement. If you go back to 2000 to 2010, the decade prior to this last decade where the S&P 500 absolutely crushed it in terms of performance, well, the S&P 500 lost 9% total from 2000 to 2010. So if we lull ourselves or allow ourselves to get lulled into this thinking that past performance will just continue into the future, you might have a really difficult time in retirement, and you may need an advisor, not just to design the right allocation, but to be an objective sounding board, because so often we fall onto what works or what's easiest or what we've been doing, and it takes that objective third party to help us make that change. You probably need an advisor if you lose sleep at night because of money, or if your thoughts throughout the day are about money and what could you be doing differently and what are you missing and what might the cost of a mistake mean for you and your family. if that's the way that you're living, you need the peace of mind that a good advisor can bring. Because again, no matter how much money you have, if you're still worried, you aren't wealthy. Working with a good advisor can help to eliminate some of that worry so that you can focus on what actually matters. Number 3, you might need an advisor if you have no idea what you're on track for. If you have no idea if you're in a position to retire, how much more you need to save, or what you need to do, that's where a good advisor can help, is coming up not just with a right investment recommendation or a right tax recommendation, but a strategy. Looking at your entire financial picture, your income, your savings, your investments, your goals, the assets that you have to work with. How do you put that together in a way that shows you exactly what you're on track for so that you can have that peace of mind of knowing you're on track for secure retirement? Next, you might need an advisor. If you look at your statement and you have dozens and dozens of different mutual funds, you probably have an advisor that's trying to make something sophisticated instead of focusing on making things simple for you. So having more isn't a sign of sophistication. Having more is trying to drum up this false complexity, because if you were to actually look at all those mutual funds, my guess is a whole bunch of them are just owning the same thing over and over and over, but giving some sense of look how sophisticated this is. You should aim for absolute simplicity to the greatest extent possible. The goal of finances isn't to complicate. The goal of finances should be to simplify so that you can know what your money is doing for you and you can focus on the life that you want to live. And then finally, you need a new advisor if you go to your advisor about a tax question and they tell you to ask your CPA. Yes, your CPA should file the return, but your advisor should really know the tax impacts of all these different decisions that you need to make with Roth conversions, with charitable giving, with understanding the taxation of Social Security versus brokerage accounts, all of these different things. If that's not an intricate part of your financial plan, you're missing a huge aspect of it. Now, at the beginning of the video, I told you I'm a little biased. I am a financial advisor in my firm, Root Financial. We work with a lot of wonderful clients, helping them to do just this. So if you're watching and saying, you know what, I'm curious, I think it is time to at least explore having a conversation with a financial advisor, be sure to check out this video here so you can learn more about how Root Financial works. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.